Hello, good day, everyone, and welcome to today's class. And in today's class, we are going to complete the accounting for non-current asset and depreciation. We are going to complete the accounting for non-current asset and depreciation. You can remember in our previous class, we were able to talk about what is the meaning of non-current assets, or what is the meaning of assets themselves. What are the different types of assets? We talk about the non-current asset. We also talk about the current asset. We make mention that, the non-current asset is further divided into two. We talk about the tangible, and we also make mention of the intangible. And here, our focus is on what? Our focus is on the tangible non-current assets. And the regulatory standard that is guiding what we are doing here is IS 16. And IS 16 deal with property, plant, and equipment. We are making reference to We are making reference to IS 16. IS 16 deal with what? IS 16 deal with property, plant, and equipment. So that's a regulatory standard on this particular topic that we are. So if you remember, during the previous class, I was able to, where do we stop? This is the work file, and today we are going to start from we are going to start from the bookkeeping entry, and we'll also talk about accounting on disposal of non-current assets. What are the accounting entry when there's a disposal of non-current assets, when there's a disposal of non-current assets. So that's the remaining two things that we need to talk about, and this is where we stopped during the previous class. So today we are going to start from the bookkeeping entries and disposal of non-current assets. What are the accounting entries? So let's use one example. And I think we make mention of this particular example before as well. So I can still continue from here using this particular example one. Using this particular example one, that look at this example one. That the cost is 3,000. The scrap value is 200, and the numbers of years is 4 years. So under straight line method. So once you calculate the depreciation, in regardless of the method that you are using, once you calculate the depreciation, in regardless of the method that you are using, what are the bookkeeping entry? What are the relevant ledger that you need to open? What are the relevant ledger that you need to open once you calculate the depreciation in regardless of the method that you're using? That is what we are talking about in the bookkeeping entries. So the bookkeeping entry now. So in the bookkeeping entries, the bookkeeping entry are just what are the relevant ledger that we need to open once it comes to depreciation. And these are the ledger that we need to open. We need to open the asset account. We also need to open this provision for depreciation account. Provision for depreciation account. Then we'll also need profit or loss. Profit or loss account. Then we also need the number 4, the statement of financial position. Statement of financial position. So these are the bookkeeping entry when it comes to what? Once it comes to depreciation. So just like the example one is that there's a certain asset which costs, the cost is 3,000 naira. Then it have a what? It have a scrap value of what? It have a scrap value of 200 naira. The scrap value of what? Of 200 naira. And the numbers of years is what? The numbers of years is 4 years. So you can remember when we calculated this particular word. So using what? Straight line what? Using straight line method is going to be what? 3,000 minus what? Minus 200 divided by what? Divided by 4 years, and which is equal to what? Which is equal to 700 naira per what? 700 naira per year. Okay, 700 naira per year. So this is the depreciation charge. So in this depreciation charge now that you have calculated, what are the relevant ledger that you need to open once it comes to what? Accounting for what? Once it comes to the bookkeeping entry. These are the relevant ledger. They are just four: the asset account, the provision for depreciation account, the statement of profit or loss, and the statement of what? The statement of financial position. These are the what? These are the ledger that you need to open. So for this particular question now, since we have the word depreciation, we have calculated the word depreciation already. So the next thing that we need to open the asset account. Let's say it is what? Is motor car what? Is motor car account. So this is the ledger, the debit, and what? The credit. Then what you are going to record in this particular ledger, it is the cost of the what? Is the cost of the asset. It is the what? It is the cost of the asset. Let's say that what you purchase this particular what? Motor car now through transfer. You transfer to this particular vendor. So you know already that your bank account is already being credited. So you are not going to debit the what? You're going to debit the asset with what? You're going to debit the asset with 3,000 naira. So this is the first one. This is the first ledger that you're going to open in the bookkeeping entry, just like you can see here. The bookkeeping entry, what are the relevant ledger that you need to open? Asset account, provision for depreciation, statement of profit or loss, and statement of what? Of financial position. So we have opened the word, we have opened the asset account now, which is the word, the motor car that we're talking about. We purchased this motor car by what? We purchased it for 3,000 naira, and we pay for it by what? We pay for it by cash. We made it what? A transfer from our bank account. So we made a transfer from our we made a transfer from our bank account. So our bank accounts could have been what? Could have been credited. We now need to what? We need to debit the motor car account. So the next thing that you need to open, the next ledger is what? Provision for what? Provision for depreciation. Provision for depreciation account. So credit and our what? And our debit. So what you are from this provision for depreciation account, this depreciation of 700 naira, no, under straight line method, meaning that what? Every year now, you are going to be recognizing a depreciation of what? 7,000 naira per year. For how many years? For 4 years. For how many years? For 4 years, you are going to be recognizing what? So meaning that what? The depreciation now is what? Depreciation is what? We are going to treat it as what? As expenses. We are going to treat it as what? We are going to treat it as expenses. We are going to treat it as what? As expenses. So you can see now the chronological order. Once you open the asset account, the next account is what? Provision for depreciation account. The next account is what? The statement of profit or loss. And the final one is what? The statement of what? The statement of financial position. So I'm open what? Depreciation account. You are not going to say what? P or L. This is what now? Let's say year one. You are going to say what? Profit or what? Profit or loss. Profit or loss, 700 naira. Then you close the account. Then you bring the balance here. You can also say here, year one. Then you say what? Balance what? Balance carried down of what? Of 700 naira. You close the account. You go to year two. You know, this is balance carried down. You bring it down. Of how much? 700 naira. What is the depreciation that you're going to charge for what? For year two? You say what? Profit or what? Profit or loss. That is the depreciation for what? For year two. Add the two together. You are going to have what? 1,400. You bring it down here. You can say here two. Year two. The balance was the balance carried down, which is what? 1,400. And you also have your what? Your 1,000. Your 1,400. Then we go to what? We go to year three. We'll bring it down. Balance brought down. Balance brought down 1,000 what? 1,400. What is the depreciation that you are going to have in what? What is the depreciation that you are going to have in year three? You say what? Profit or loss. Profit or loss. How much is it? Is 1,700. So 1,700. Addition of the two, you are going to have what? This is 2,1. You close the account. You come here as well and close the account. 2,001. This one will be our what? Our balance carried down. 2,001. This is what now? This is year three. Then you go again to the final one, year four. Balance was balance brought down, which is what? 2,1. What is the depreciation that you are going to charge for the final year? It's still the same amount, since we are using what? Straight line method, profit or loss. If you are using straight line method, the depreciation is going to be what? Is going to be the same throughout the what? Throughout the useful life of the asset. So this is what now? 2,800. Then this is year four. Balance. We'll close the account to 2,800. So this is how you what? This is how you prepare the what? This is how you prepare the what? The provision for depreciation account. This is how you prepare the what? The provision for depreciation account. Then the next ledger that you need to open now is the what? The statement of profit or loss. The statement of what? Statement of profit or loss. Statement of profit or loss. Okay, so now you can see now that look at this place now. In this provision for depreciation, now you can see on the credit side, we say what? Profit or loss. So when you now open what? Statement of profit or loss, the one that is on credit now, it will now fall to where now? It will now fall to what? To debit. The one that is on what? The one that is on credit now, it will now fall to the what? To the P or L debit. Okay, so if you now open P or L, you are going to open your P or L in vertical format. You're going to open your statement of profit or loss in what? In vertical format. This particular topic, we are still going to talk about it. So this statement of profit or loss is divided into two. This statement of profit or loss is divided into two. It is either it is what? Expenses, or it is what? It is income. The statement of what? Statement of financial position will have three elements. It's going to contain assets, it's going to contain your what? Your equity, and it's going to contain the what? The liability. You know, we have how many elements of financial statement? We have 5 elements of what? Of financial statement. We have the what? The expenses, the income, the asset, the equity, and the what? And the liability. So your income and expenses is going to it will be in your statement of profit or loss, while your asset, your equity, and liability is going to be in your what? In the statement of what? Of financial position. So let me now tell you something. This is the what? This is the T format of what? Statement of profit or loss. But we are not going to use this T format to prepare statement of profit or loss. This is profit or loss. If some of you, if you are a commercial student now, you'll be aware of this. You can remember, this is how you prepare it in your what? During your secondary school days. In your statement of profit or loss, expenses is going to be here, while income is going to be here. Please don't forget. If someone asks you now that debit statement of profit or loss, if someone said that, oh, debit statement of profit or loss, what does it mean? It means that that particular item is what? Is expenses. If someone tells you now, oh, I want you to debit statement of profit or loss, it means that that particular item is what? That particular item is expenses. If someone say what? Credit statement of profit or loss, it means that particular item is what? That particular item is income. If someone say what? Credit statement of profit or loss, it means that that particular item is what? Is income. If someone say what? Debit statement of profit or loss, it means that that particular item is what? Is expenses. So this is how we prepare statement of profit or loss in the olden day using what? T format. But when we want to prepare it now, we are not going to prepare it using what? T format anymore. We are going to use what? Vertical format. So in the vertical format, you are just going to say expenses. Don't worry, you still know how, you say what? Depreciation. So you cannot say what now? Year 1, you can say 2, you can say year 3, and you can say year 4. So you are going to be recognizing what? 700 naira in your statement of profit or loss. That's it. So you can see now that every year now, you can see, you say year 1, POL 700. Year 2, you also say what? 700. Year 3, POL 700. Don't look at the balance brought down. We are still going to talk about it later now. Year 3, you also say POL 700. Year 4, you also say POL. So you have bring it down. So this is how we prepare statement of profit or loss. We prepare it in what? In vertical format. We prepare it in what? In vertical format, not the T format. But please, I'm begging you, I still want you to please don't forget this thing. It's very, very important. Don't forget this thing. If someone asks you now that debit POL, it means that that particular item is what? Is expenses. If someone say what? Credit what? POL, it means that that particular item is what? Is income. So please don't worry, please don't forget this. All right. Then the last thing that we need to do, which is this one, is like what? Number 3 now. We now have what now? Number 4, which is what? Statement of what? Statement of financial position. Statement of what? Statement of financial position. Statement of financial position. We'll call it what? Extract, because it's not full. We'll call it what? Extracts, because the information here is not what? Is not full. Because in this particular thing now, in the statement of financial position, in the statement of what? In the statement of financial position, how many items is going to be there? 3 items will be there: assets, equity, and liability. But in this one now, the information that we are showing here is only relating to assets. So that's why we call it what extra, because it does not contain the full information about what statement of financial position needs to contain. For you, when you say statement of financial position, it means that we expect you to have asset there, we expect you to have equity, we expect you to have liability. But if you discover that what this three information is not there, you are going to call it what extract. So what we are not going to do, you are not going to say something like this. You say your asset, then you say the word, the motor car. So in the motor car now, this will be like what now? This will be like year one. So we'll say the word, the cost, then we'll say what accumulated with depreciation, then we'll have our carrying amount. Which some of you, if you can remember, maybe in your secondary school, if you're a commercial student, you call it what net book value. We don't longer call it what net book value, NBV. We call it what the new name now is what is carrying amount. The new name now is what? The new name now is carrying amount. So what is the cost? What is the cost of the asset? How much do you buy it? You pay 3,000 naira. What is the depreciation for year one? Is 700. So the balance now is what now? The balance now is going to be what? 2,300. You go to what now? Year two. You go to what? You go to year two. Motor car. The cost is what? The cost is still going to be 3,000. Now, what is now the accumulated depreciation? The accumulated depreciation will not be the what? The closing balance as at the end of that particular period. It will not be the what? The closing balance as at the what? As at the end of that particular period. The closing balance as at the end of what? Year two, that is 1,4. The closing balance at the end of year three is 2,1. The closing balance at the end of what? Year four now is what? Is 2,8. So it is the closing balance that you are going to bring into the what? To the statement of financial position. Because statement of financial position see item in what? In accumulated form. But statement of profit or loss is only consider about what happened during this particular year. What happened during this particular year? What happened during this particular year? But statement of financial position will see that, oh, from the beginning of the business to now, what is the depreciation? But statement of profit or loss is only concerned about the what is the depreciation of the year. Statement of profit or loss is only considered about what is the depreciation for that current year. But statement of financial position will look at, oh, what is the total depreciation to date? What is the total depreciation to date? The total depreciation to date at the end of what? Year two is 1,4. At the end of year three is 2,1. And at the end of year four, it is 2,8. So it is this total depreciation now that you are going to bring in. So 700 plus 700 now, that is what? 1,4. So if we say what now? 1,4. 3,000 minus 6, then you have what? 1,6. You go to what? To year three. You go to what? To year three. So if you go to what? To year three now, the motor what? The motor car still remain the same. The cost is what? Is 3,000. Then the depreciation, 1,4 plus 700 now, you have what? 2,1. 2,1 minus this, you have what? 900. Then we go to the final year now, which is what? Year four. So in year four now, motor car is what? Is 3,000. Then the depreciation is what? 2,1 plus this, you have what? 2,8. So you can see you have what? 200 now at the end of the year. You have what? 200 at the end of the year. This 200, we have it already in the question. That is the what? That is the scrap value. That is the what? That is the scrap value. That is the scrap value. This is it. The cost is 3,000. The scrap value meaning that, oh, at the end of 4 years, this is the amount that you're able to sell this. So at the end of your work, at the end of the year, you must also arrive at what? You must also arrive at 1,000 words. You must also arrive at 200 naira, and which you can also see. So this is how we prepare. These are the relevant words. These are the relevant ledger that you need to open when it comes to what? When it comes to depreciation. Once you want to account for what? You want to account for depreciation. Okay? These are the relevant words. These are the relevant ledger. So now, let's go back to our general practice question, and you can solve what? You can solve at least a minimum of 2 questions, and then I'll give the rest as an assignment for every one of us to please attempt. So now, in our general practice question, and this is question 1. What is the requirement of question 1? That's the first thing that you need to do. Once you are given any question, you need to look for the requirement. What does the examiner want you to do? What does the examiner want you to work? What does the examiner want you to do? I say you should prepare the motor vehicle account, the depreciation account, the disposal account, the income statement, and the statement of financial position for 9, 10, and 11 words only. So these are the requirements: motor vehicle accounts, provision for depreciation accounts, disposal. So when we say disposal, from the word disposal, it means that that particular asset was what? That particular asset was sold. That particular asset was what? That particular asset was sold. Okay. So I want you to please listen to this particular question very well. It's a very interesting question, and it covers everything, honestly. It covers what? It covers everything. Please listen to this question very, very well. So Guarantee Limited make up the account annually to 31st of December and provide for depreciation of his vehicle at the rate of 25% per annum on straight line basis. It ignores scrap value when calculating depreciation per annum. Depreciation will also be charged based on the period the assets are put into use. The record of acquisition and disposal show the following. January 1, 2009, vehicle number 1 costs this. So that's mean that they are what they are buying. The second additional information, on January 1, 2010, vehicle number 2 was also purchased. On January 1, 2012, vehicle number 3 was also purchased at the cost of 800 Ghana cedis. On the same date, vehicle number 1 was sold for what? For 100K. On January 1, 2013, vehicle number 4 was also purchased at the cost of what? 1 million. So based on this information now, let's open the asset account. That is the first requirement. That is the first requirement. That is the first requirement. Okay. So these are the relevant ledger. Starting from the first one, this is an asset account. So when you are buying, you debit. When your asset is increasing, what are you going to do? You debit. If your asset account is what is increasing, what are you going to do? You debit. So this is the first year, which is 2009. We can say what? So you pay for your what? You pay for it. You pay for it, and you purchase a what? You purchase a vehicle number one for 400. So that means that your bank could have been what? Could have been credited. So we are not going to debit. If your asset account is increasing, you debit. So I will say what? Bank now. Bracket vehicle was one. How much is it? 400,000. Then we can close the account and say what? Balance was carried down, which is what? 400,000 as well. We can go to the next year, which is what? 2010. Even though there's no any transaction, you must still record what? 2010. Even though there's no any transaction, you must still see what's 2010. On January 1, 2020, vehicle number 2 cost 600. So this is your balance that you have before. The balance brought down, which is 400. So you also buy what? Vehicle number 2, which costs what? 600. So addition of the two now, we have what? 1 million. Then balance what? Our balance brought down of 1 million. So we'll go to the next year. After 2010, which year again? 2011. The balance what? Balance brought down 1 million. Even though there is no any transaction in 2011, you will still open 2011. So what happened in 2011? There's no any information in what in 2011. Okay, there's no any information in 2011. So, but you still need to open it. Don't just go to 2001 or 2012. Even though if you did not have information, you still need to show it. So we can go to what? We can go to 2012 now. So this is 2012. So in 2012, this is our balance what? Balance brought down, which is what? 1 million. So what happened in what? In 2012? Sorry, what happened in 2012? On January 1, 2012, vehicle 3 cost 800. So a new vehicle is coming in. Vehicle what? 3. It costs what? It costs 800. So this is automatically what? 1.8 million. Close the account. Then what happened again after the full stop? On the same date, vehicle number 1 was sold for how much? Vehicle number 1 was sold for 100K. Vehicle number 1 was sold for 100K. That is the amount that you sell what? Vehicle number 4. I'll be sorry, vehicle number 1. What you are not going to do, is forget about that particular amount. Please don't forget. Forget about this particular amount, 100,000. This is the amount that you receive when you sold this particular car. Forget about the word, forget about the amount. What you are going to record now in this asset account, we are not going to use this 100,000 for now. It is when we are doing disposal account that we are going to be talking about that one. What you are going to do, please don't forget, in this asset account is what is the amount that you buy this particular what? That you buy this particular what? Vehicle 1. That is what you are going to record here. You are not in this asset account, you are not recording the amount that you receive. You are recording the what is the cost of that particular asset. In this particular asset account, you are not recording the sales proceed that you receive from disposal. You are going to record the cost of the assets. You are going to record the cost of the asset. How much do you buy vehicle one? It is 400,000. So you say now 400,000. And you know already, if your asset is reducing, what are you going to do? You credit. If your asset is reducing, what are you going to do? You credit. So what is the balance? The balance now is what? That's 1.4. That's it. Then do we have 2013? Okay, that's 2013. We'll go to 2013 too. Balance brought down is what? 1.4. And what happened in 2013? On January 1, 2013, vehicle 4 was you purchased vehicle 4. So bank vehicle 4, which is 1 million. So addition of the two, that's 2.4. So this 2.4. So you can see how simple it is. The very simple stuff. This is 2.4. So when you get to 2014, there's no end transaction. So you just bring it down. You just see what balance brought down of 2.4. And that's it. So that is that about this particular ledger. Have a look at it, please. That is that about this particular ledger. Please don't forget this. Where is the disposal? You are using the cost. You are using the cost of the what? Cost of the asset. Not what? Not the proceed. Not the proceed you receive. Please don't forget. You can see I'm taking my time to write this thing again. You are using the cost of the asset, not the proceed you receive here. Okay? And that is it. The next account, based on the what we just finished to talk about now, is what? Provision for what? Provision for depreciation accounts. Provision for what? Provision for depreciation accounts. Provision for depreciation account. Our credits and our debits. So you say what now? POL, or you can call it statement of comprehensive income. So what is the depreciation? Look at, they say provide for depreciation of the vehicle at the rate of what, 25% per annum on straight line basis. So that means that the rate of depreciation, and you are not calculating it. The rate is already given. And they say that the rate is what? The rate is 25%. So if you say what now, 25%, you see 25% is 0.25. I want to calculate depreciation for vehicle 1. Then multiply by what is the cost of what? What is the cost of vehicle 1? That's 400,000. Multiply by 400,000. Then I have what? 100,000. So I will just go here now and say what? 100,000. That's all. This is what here. This is 2009. This is 2009. Then you see what? Balance what? Balance brought down 100,000. Then we'll go to the next year, 2010. 2010. Balance what? Balance brought down is how much? It's 100,000. Now, the next thing that you're going to do is that, what? Okay, what is the what? What is the value of your asset in 2010? In 2010 now, you have 1 million. In 2010, you have 1 million. It's still at the same rate. It's 0.25. That is 25%. Then multiply with what? What is the value of the asset that you have? That is what? 1 million. Then you have what? 250. That will be your depreciation. Then you multiply the 25% on the value of the asset that you have at the end of that year. So at the end of that year, I have what? 1 million what? 1 million value of asset. 25% of 1 million, that's 250. So that will be your depreciation. Then you say what? Pure statement of profit or loss. This is 250. Now, add the two together. 250 plus this, we have what? 350. And balance carried down is 350. And we also need to close the account with 350. We'll go to 2011. This is what? Balance brought down 350. So in 2011, what is the value of your asset? Sorry, what is the value of your asset in 2011? In 2011, the value of your asset is still 1 million, so which is still going to be what? 250. In 2011, the value of your asset is what? Is still 1 million, no transaction. So the value of your asset is still what? So you still see what? POL, or you can call it what? Comprehensive income, statement of profit or loss and other comprehensive income. That is in million. So this is 250. So you close this two. 350 plus this, that's 600. Oh, sorry. So our balance carried down is 600. And we close the account. 600. And we'll go to the next year, 2012. We'll go to the next year, 2012. What is our balance brought down? So in 2012, what will be the depreciation? So in 2012, what is the value of your asset? The value of your asset, which is the balance, is 1.4. Is what is 1.4. So 0. What? 0.25 multiplied by what? 1.4. Then you have what? 350. 25% of 1.4 million is 350,000. So then you write what? 350,000. So 350,000 plus 6, this is 950. Then you see what balance what now? Balance carried down 950. Let's close the account. This is 950. Then 2013. 2013. So in 2013, the balance brought down is what is 950. So what is the value of the asset that you have at the end of 2013? Now it's 2.4. So 0.25 multiplied by what is 2.4. That is what 600,000. That's 600 what 600,000. 600,000. So this is 600 what 600,000. So you close the two accounts. 600 plus this. This is 1,250,000. And close the account as well. $1,250,000. So the balance will balance carried down 1,250,000. No, oh sorry. Let me not tell you something. You know, in 20 words, sorry, we have some words. Now, you know, in 20 words, you know that in 2012, you know that when do we sell? You know that in 2012, we dispose some certain asset off. We dispose some certain asset off. So we need to remove that asset that we are selling off. We need to remove that word. We need to remove that asset that we are selling off. You need to remove the depreciation of that asset that you are selling. You know that asset is what is going out. So you need to remove the depreciation as well. If you want to reduce this provision for depreciation account, you are going to debit. If you want to reduce it, it's like a liability account. It's like a what? A liability account. If you want to reduce it, you are going to do what? You are going to debit. So now, since you are selling asset now, the depreciation will also go out. The cost will also go out. That's just the interpretation of it. Since you are disposing a certain asset now, vehicle 1 in 2012, since you are selling it out now, the depreciation will also go out. So you now need to determine what is the depreciation as at the time of disposal. What is the depreciation as at the time of disposal? You buy this particular asset in January 2009. So that means that it's already been depreciated by 100,000. In 2010, another 100,000. In 2011, another 100,000. So that is making what? 300 what? That is making 300,000. What I'm saying now is that I'm going to write disposal here. disposal here is 300K. So if we say what this 300,000 minus this, so that means that we are going to be having a balance of this. So, and this should what, sorry, this should come here. Why this should go up first. Why this should be here. Why this should be here. And this should be here. So how do we get this? You know that this particular one, this particular asset now, you purchase it in when? You purchase it in 2009. So the cost, the cost is what? Cost of the asset. Cost of the asset is what? The cost of the asset is 400. 2009 was depreciation is 100,000. 2010 depreciation is 100,000. And 2011 depreciation is also what? Is also 100,000. So that means that this particular asset now, the balance is what? The balance is 100,000 as at the time that you are selling it. So total what now? Total depreciation is equal to 100 plus what plus 100 plus what plus 100, which is going to be what? 300,000. So that's how we get this particular 300,000 that we are referring to. Okay. As you are selling this particular asset in January 1, 2012. So you are not going to depreciate it then. So the total depreciation will not be the depreciation of 2009, 10, and 11. So that means that the balance that we have now is what? The balance that we have now is what? Is 650. So we are going to say what now? 650,000. So, and you say what 650 plus this, I think that's how we are arriving at this particular figure. Then you go on to what? You go on to 2014. Then you go on to what? To 2014. In 2014, it will just be what? The balance brought down, which is what? 1,250,000. So that is that. So this is how you prepare the what? This is how you prepare the depreciation account. I'll be sorry, this is how you prepare the provision for the depreciation account. Don't forget, this is very, very key. This is very, 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 very key. And in this particular one as well, this is also very, very key. It's very, very important. Don't forget it. You are using the cost of the asset, not the amount that you receive. Okay? So we are not going to be considering what we are going to consider the amount that you receive in this particular account now, in this particular requirement, which is requirement C. Requirement C now is asking you to prepare what? Is asking you to prepare disposal accounts. It's asking you to prepare what? Motor what? The motor vehicle disposal account. This is our debit and these are credits. Okay. So in this disposal account, the first thing you need to consider is that how much do you receive when you sell this particular asset? How much do you receive? And it will be given to you in the question. They say on the same date, vehicle number 1 was sold for how much? So that means that this is the amount that you receive. So when you receive this particular amount now of 100,000 naira, your bank, or if let's assume that this transaction was carried out through the bank, your bank is increasing. So meaning that what now? You could have debited to your bank with that 100,000. The corresponding entry for you now is to now credit this disposal account. You have debited your bank with 100,000. The corresponding entry now is for you to credit this disposal account. So I'm going to say what now? Bank. So meaning that what the bank now could have been what? Could have been credited. Sorry, the bank could have been debited. That's why you're not crediting the disposal account with 100,000. Now, the next thing that we now need to look for is that you can even look at where do you see disposal in each of the ledger that you have prepared? You can see disposal. You can start from the beginning. Look at it now. In requirement 1, and this is motor vehicle account. I can see disposal now. In 2012, 400,000 is on what side now? Is on the credit side. When you now open disposal account now, it will now go to where now? It will now go to the debit side. So I'm now going to say what now? From where? The asset account, right? Which is what the motor vehicle. So the motor word. Okay. So this is where we are going now. We'll just say what? Motor word now. The motor vehicle. So if you check the motor vehicle account, you are going to see what? 400,000. Now, if you look at where do you see disposal again? I can see disposal in provision for depreciation. Is in what side now? Is on the debit side. It will now go to the disposal account as what now? As credit. It will go to the disposal account as what? As credit. How much is this? It's 300,000. So you say now, provision for what? Provision for depreciation. Provision for what? For depreciation is how much? In the provision for depreciation, it is 300 or 300,000. So you add the two together, and you have what? 400. If you come here as well, it will give you what? 400,000. So it means that in this particular transaction, there's no profit and there's no what? There's no loss. There's no profit and there's no what? There's no loss. So you now need to what? Look at this particular section now. If you look at this particular section in the note that words you have already, in this particular word, in this particular note, in this particular word, in this particular note that you have. So you can see, we say that what? Look at here. Under this word, disposal account. In disposal account, look at it so that look at, they say when the non-current asset disposal account end in a credit balance, it means that the amount received from the sales is more than the carrying amount of the what of the non-current asset ends as a profit, and vice versa. What we are saying that let me use another thing as an example. Let's say here now, I have what? Let me just do something here. This is my disposal. In the bank, I receive what? 200. And provision for what? Provision for depreciation is what? Is 300. And the asset is what? The asset is still what? Is still 400. So if I say 400, so you can see now, if I have these two together now, I'm going to have what? 500. Then you're not going to say what? POL. Statement of what? You say what? Profit or loss. Profit or loss. So the difference is now what now? The difference is now 100 what is now 100,000. So that you're able to have what 500 what thousand. So when you now go to your P&L, we are saying what P&L. This is what I explained to you before. If you are using what, if you are using T format, but we are not going to use T format. So if someone now informs you now that, oh, I want you to credit P&L with what? With 100,000. It means that one is what? Can you remember? If I say credit P&L with 100,000, it means what? It means it is income. So you can see now in the disposal account, you say P&L is on what side? Debit. Here it will now what? It will now come to what? Of 100 what? 100,000. And anything on the credit side of the P&L, it means what? Income. Anything on the credit side of the P&L, it means what? Income. So this is what now? Let me say this is example. This is what now? Example. Example 1. Example 1, where profit is made on what? On disposal. But this is how we prepare it. We prepare it in what? In vertical format. So you will just say what? You will just say, can just say income. This is a statement of what? Statement of profit or loss. You just say disposal. How much? 100,000. Now, example 2. Where loss is what? Is made on what? On disposal. Where loss is made on what? On disposal. If there's a loss on disposal, let's say this is disposal account. This is example 2. This is our debit, and this is our credit. I'll say what now? Bank. Let's say bank, 50,000. That is you sell this particular asset for what? For 50,000. The depreciation is what? Is 300. And the assets was originally what? Cost. The asset cost is what? Is 400. So that means that what? The debit side now. So you're not going to say what now? P&L, profit or loss of what now? Of 50,000. So that you're able to have what? 400, and you're able to have what? 400. So this would be what? 400 and 400. So meaning that, and you can see it from the note as well. Let's say when the non-current asset what? When the non-current asset disposal account end in the debit balance. So meaning that the debit is more than the credit. The debit is more than the credit. This is 400,000. If you add all this together, now you're having 350. So meaning that the debit now is more than what? Is more than the credit. Hence what? Hence loss must be recorded. So you debit the statement of profit or loss, and you credit the non-current asset account. So you're not going to say what? Assuming that, I'm still referring to but you're not going to use this in the exam. This is what? P&L accounts. This is your credit, and this is your credit. P&L is on what side now? Is on the credit there. So it will now come to this place as what? As debit. How much? 50,000 naira. So you just say what now? Expenses. Loss on what? Loss on disposal. How much? 50,000 naira. This is a statement of what? Profit or what? Or loss account. So these are the two situations in which when there's a profit or there's a what? Or there's a loss. Okay. So if we have a profit, the credit will be more than the debit. So we have solved those two examples now. So look at it now, where we have profit and where we have what? When we have loss. When we have profit, the credit side of the disposal account is greater than what the debit. But when we have loss, the debit side is greater than what the credit side of the disposal account. So that is it. So in this particular question now, the disposal account, there was no word. So these are what now? Let me demarcate this one. This one is what? This is example. These are what? These are example. So that it's on. These are what? So what is the next requirement? The next requirement is that what we should prepare the statement of profit or loss and the statement of what? The statement of financial position. The statement of profit or loss and the statement of financial position for which year? 9, 10, and 11. 9, 10, and what? 9, 10, and 11. So you will just say what now? This is the what? The statement of what? Statement of what? Of profit or loss. Just like we have done that before, right? The statement of profit or loss. So the statement of profit or loss, that is the requirement D, part of the requirement D. So you say what now? Expenses. So you're going to say 2009, you say 2010, and you say 2011. So what's the name? The name is depreciation. Okay, for time's purpose, let me just do this. So what's the depreciation? I think the first year is what? In the first year is 100,000. Let's go to the one. What is the next 2 years? We have what? We have 250, 250, 250, 250, 250, 250. So this is what? 250. And this is also 250. So, and that is that about this. Then the last one is what? Statement of what? Statement of financial position. Statement of what? Of financial position. Statement of financial position. Brackets, extracts. Okay, so underline it. So what you just need to do, you can say what? Assets. And this one is what? This one is non-current what? Non-current asset. You can say the cost. You can say what? Accumulated what? Depreciation. and we say what carrying was the carrying amount. So that is that. So we are only showing for what for 2 years. We're only showing for what for 2 years. So this is still the what motor vehicle. So we can say year 2009 motor horse, motor vehicle. The cost is what? The cost is 400. And the depreciation is what? The depreciation is 100. This will automatically be what? Be 300 at the end of the what? In 2010, what is the value of the asset that we have? What is the value of the assets that we have? The value of the asset that we have in 2010 and 2011 in 1 million, 1 million, 1 million, 1 million, 1 million, 1 million. So that is that. That is the cost. So this is what? This is 1 million. And when you go towards to 2011, the motor vehicle is still what? Is still 1 million. So you now need to bring the what is the accumulated depreciation in 2010 and 2011. So you go to the provision for depreciation account. You go to what provision for depreciation account. So provision for depreciation account 11. In 2010, 2010, the total was the total depreciation is what in 2010, the total depreciation is 650, and in 2011, it is what 600. So the total depreciation in 2010 is what is 350, and in 2011 is what is 600. 350, 600. And we are through with what now? We are through with this question. And everything that you need to understand once it comes to what to depreciation account, I have fully explained it. I have fully explained it. So this is 350. And this is what? This is 600. So 1 million minus, this is what? This will be 650. And this will be what? 400,000. So, and that's all about this beautiful word, beautiful question. It's covered everything that you need to be what? It's covered everything that you need to be aware of. One is come to what? Depreciation. Once it's come to what? One is come to depreciation. Once it's come to what? To depreciation. It's covered every other thing that you need to be what? That you need to be aware of. It's covered everything that you need to be aware of. So let me now give you a certain task now as an assignment. And I want you to do question what 2. Do what? Do question 2. Do question 2. But if you really understand if you really understand question 1, it's cover everything that you need to know. It's cover everything. The example that I'm giving, once is disposal account, once there's a profit, once there's loss, I've discussed everything. So, and I'm going to grant you what a retentive memory. So I want you to watch to solve question 2. So if you look at what question 2 now, they show what? Show relevant ledger. They say show relevant ledger. So if the examiner does not make reference to what the ledger that you need to open, so meaning that what you need to open you need to open everything. If the examiner does not give you what, if the examiner does not give you, you can see now in this particular question, the examiner does not mention the ledger that you need to open. The examiner just say what, show the relevant ledger entry. Show the relevant ledger entry. So for what? For depreciation, when they say what show the relevant what ledger was the ledger entry now. So meaning that what are the ledger entry that you need to show? Let me tell you. What are the relevant ledger that you need to what are the relevant ledger that you need to show? The relevant ledger that you need to show once it's come to what? Once it comes to depreciation, I have informed you. So another thing, which okay, let me just scroll, which you have before. It's just the bookkeeping word, the bookkeeping entry. The bookkeeping word, the bookkeeping entry. So if you can remember at the beginning of this class, we talk about this. So I make mention of 4. So if there are only 6 ledger that you can show. I think there are only 6. We make mention of what? We make mention of 4 there. So an additional one to it is number 5. If there's a disposal in that particular question, you can also show what the disposal account as well. So making 5 now, disposal account. So what you now need to check for now is that, okay, did they make mention of what disposal in this particular question? And let me read through with you. I say a business has a machinery which causes, during the year, it added another one at this. It is a policy to depreciate this on straight line. There's no problem. The total provision stood at this. The business sold the machine for this, which is purchased exactly 2 years ago. So meaning that in this particular ledger now, you only need to show the words. So in question 2 now, you only need to show 3 ledger in this question 2. You only need to show the asset account, the depreciation account, and disposal account. You only need to show the asset account, the depreciation account, and and disposal account. Those are the 3 ledger that you need to show relating to this particular question. Those are the only 2 ledger that you need to show relating to this particular question. Those are the 2 ledger. Those are the 3 ledger that you need to show: the asset account, the provision for depreciation account, and the disposal account. The question 2. That is the plant and machinery account. The second part is provision for provision for depreciation account. And the third part is disposal account. So these are the 3 ledger that you need to show for this particular question 2. So attempt this. And you still have other things that you can do as well. So let me just rush and do it. The first one is this is question 2. The plant and machinery accounts. The plant and machinery account. So in the plant and machinery account, you need to look for, okay, what is the debit, what is the credit? So this is the debit, this is the credit, this is 1. So what is the cost? How much do you buy the asset? Let's say it costs 220, Abi. So let's say a business has a machinery. So you has a machinery. So that means that, okay, this already existed before. This is what 220. Okay. A business has a machinery, okay, which is this. During the year, it added another one, which is 80 addition. So if your asset account is increasing, what are you going to do? You debit. So this is it, making what now? Oh, sorry, this is making 300. This is 300,000. So Okay. It's a policy to make a provision for depreciation of what of 20% per annum. The total provision is the business sell a machine for 38,000, which he purchased exactly 2 years ago for how much? For 60,000. You know, I told you this before. In asset account, you're only going to show how much do you buy the assets, not how much do you receive when you are selling it. How much you yourself do you buy it? That's the amount that you're going to show in the asset account. So you are going to see what now? Disposal. How much? 60,000 naira. So your balance now is what? That's 240. This 300. And this is 300. It's as simple as that. And the next one is what? Provision for what? Provision for depreciation account. Credit and what? And debit. So go to the question. Let's say the total provision now stand at what? So this is the balance brought forward. I mean, the balance brought down, or anyone you call it. As at now, we have what? 140,000 naira. Abi? The business sell a machine for 38,000 naira, which he purchased exactly what 2 years ago for how much? For 60,000. So we need to calculate what depreciation now on the one that you are just what? The one that you are just buying. So what you need to do now is just for us to say that, okay, what is the depreciation I'm going to charge for the current year? So you can say what now? P or L. Get that first. P or L. What is the rate? The rate is what? 20%. So 20 divided by 100 multiplied by what is the value of the asset that you have now? What is the value of the asset that you have now? The value of the asset, which is the balance down here, is always put it. Let's scroll. Balance brought down. Balance brought down is 240. That's the value of the asset that you have now. So you see what now? 240. So you're now going to say 20% of what? Of 240,000. So 0.2 multiplied by 240. That's 48,000. So this is 48,000. So your total depreciation now is how much? This is 188,000. So you close the account as well. 188,000. And we'll be expecting a what? We are going to be expecting a balance. We are going to be expecting a balance. This is what you have before. This is the new this current year depreciation now is going to be based on the percentage that is given to you, multiplied by the what? Multiplied by the value of your asset as at the end of that particular period. So now we are now being told that there's a word now. There's a depreciation. I mean, there's a disposal. So you can just say disposal here first. Then we'll be waiting for our balance. So what you just do, let's say what the business sell a machine for this, which is purchased exactly what 2 years ago. You purchased it exactly what 2 years ago. So what could have been the total depreciation that you could have charged on it for 2 years ago for 60,000? So what you just do, what is your depreciation policy? It's on 20%. So 0.2 now multiplied by 60,000. What do you have? You can do that also. So you have 12,000. So that means that every year now. So 12 multiplied by 2, that's 24. How do you get the depreciation? This is how you get the depreciation on the what? On the disposal. So this will automatically be what? 24 what? This will be 24,000. And if you say 188 minus this will be what? But it's 164. So how do you get this? Since you purchased the machine 2 years ago, and your policy is what? Your policy is 20%. So if you say what is 0.2 multiplied by how much do you buy it? It is 60,000. That will give you what? 12,000. So 12,000 multiplied by what? Multiplied by 2 years, you have what? 24,000 naira. And that's exactly. So the last one is to prepare your disposal account. Number 3, disposal account. Okay, this is your debit, this is your credit. Okay, always put the unit of measurement, please don't forget. So how much do you receive when you sell it? The business sell a machine for 38, so this is your bank, 38,000. Then the depreciation is what? Is 24. If you check the assets, plant and what? Plant and machinery, you go up again and check the plant and machinery. Check the ledger that you have prepared, the first ledger that you prepared. The first ledger that you prepared, and you can see disposal on the credit side, how much? 60,000. So it's on credit here, so now come here as what now? As debit. So this is what? 60,000. Okay. So if you had 24, you say what? 24 plus what? 38. 24 plus 38, that's what now? 8 plus 4, that's 12, Abby. So write 2, and this is what? 62. So that means that the credit side is greater than the debit. So, and if the credit side is greater than the debit, that means that we have what? We have profits. We have what? Profit. So there's going to be, sorry, you can just say profit or what? Or loss, which is what now? 2,000. So since there's a relevant ledger, you can as well now show your what now? Show your statement of profit or loss. So you just say what now? Statement of what? Statement of profits. No, I mean, or statement of profit or loss. So you say what now? You underline it, please update it very well in your book. You say income, and you say what? Profit on what? Profit on disposal. Profit on disposal, which is how much? 2,000. Okay, so that is it. So don't forget, it is here already. If the credit side is greater than the words, if the credit is greater than the debit, there's a what? There's a profit. If the debit is greater than what? If the credit is greater than debit, there's a profit. If the credit side is greater than the what? This is the credit side. The credit side is greater than the debit side. In disposal account is going to result in what? In profit. So that's it. I hope everybody gets this. These are the ledger. You have an asset before, 220. You buy a new one, addition of the 2, 300. You sell 60,000. 300 minus 60. This is the depreciation that you have before, 140. The new depreciation for the current year, 20% of the current one is 48,000. Add this together. When you dispose an asset that you acquire 60,000 2 years ago. So based on depreciation policy, 0.2, that is 20% of 60,000. You have 12. 12 multiplied by 2, you have 24. So here too, you can also include, you can even say expenses. In the expenses side, You see what now? Depreciation. So you say because the current year or the current year depreciation. Current year depreciation is what is 48,000. And that's it. So these are the what? These are the relevant ledger for this particular question. These are the relevant ledger for this particular question. Okay. You can, and I'm giving you the task now. Do the what? Do statement of the what? Do statement of financial position. Do the statement of what? Do the statement of financial position as an assignment. Thank you, everyone, and God bless you all. If you have any question now, please, you can bring it in. Make sure you master all the examples, especially what question 1 that we saw. Try as much as possible to understand. It's not a difficult subject, okay?